Hi, this is Nate Williams. Today I'm recording a video called the PFG Cash Management System. Now, I've been told that videos need to be very short, longer than 30 seconds, maybe a minute, and people won't watch them. But some things that are more complex and require a deeper level of understanding can't be learned from a TikTok video. So I'm going to try really hard to not over embellish, but what I have to talk to you about today is so important that it's going to take a little bit of time. The cash management system, or how you manage cash flow, is as important to your short and long term financial success as brushing and flossing is to your oral health. It's as important as exercise and eating healthy is to your physical health. The cash management system, how you manage cash, is essential to your short and long-term financial success. I cannot overstate this. And so what we're going to talk about today is a system that we've put in place for our clients to help you effectively manage cash and play this financial game to win. So I want to talk for a minute about what a treasury department is and does. First of all, as I just mentioned how important cash is, another street phrase is cash is king. You've all heard that. Any well-run large business or large organization has a separate department called the Treasury Department. The Treasury Department's job is very simple: manage cash. In the US government, for example, the Treasury Department's job is to manage cash, and the US Treasury is one of the largest departments in the entire government. So, if you're going to make progress towards your financial goals, you need a Treasury Department or a cash management department, some way to effectively manage cash in your favor. To continue on the importance of cash flow, cash is to your financial plan what water is to a farm. Water needs no explanation. It is the single most valuable resource on the entire planet. You get rid of water, you remove life. Cash is like that. And a cash flow system is like irrigation is to a farm. So your practice is the well that creates the cash. Your practice, you work, you produce, you collect money, money comes into your bank account. That is the well that creates the cash or the water, and the cash flow system is how we get that to the different parts of your financial plan that need cash. So clearly, like water to a farm, there are obvious problems if there's not enough water. I don't need to give a bunch of examples of the ills of running out of cash. But what people don't understand is there's also a problem with too much cash. You need just the right amount of cash and the cash going to the right places, or else you've got problems with drought or you've got problems with flooding, and they're both problematic. Having too much cash sitting around is like having a bunch of employees who just sit around and do nothing. Obviously, that's problematic and wasteful. So a well-run business will create a cash flow system that puts cash to work. And that's what this video is really about. So as you can see, this pristine farm, picture taken right here in my hometown, where you've got a perfectly designed irrigation system where just the precise amount of water gets to the plants at precisely the right time. And this is exactly what we're trying to create with your cash flow system. So let's talk for a minute about the attributes of an ideal cash flow system. Attribute number one is money gets to where it needs to go. In other words, bills are paid with minimal effort on your part. And we don't want anything on your mind we don't want you remembering, oh, I have to remember to pay that insurance bill. So we want to remove having to remember things, and we want to minimize effort taken to get the cash where it needs to be. Attribute number 2, there is enough cash. You're not stressed out about running out of cash. Do I need to talk more about this? Attribute number 3, there is a system to identify surplus cash. This is really important. I can't emphasize how important this is. Most doctors, when they look at their bank account, let's say they look in their bank account and they see $100,000. Well, that's great. But how many of them know how much of that $100,000 is theirs to spend? How much of that is surplus that they can comfortably and confidently take out of the practice and go and use towards their financial goals? So there needs to be a system to identify what is surplus cash. There also needs to be a plan in place of what to do with the surplus cash when you have it. It's great to identify that you've got $20,000 of surplus. Now, what are you going to do with that $20,000? There needs to be a structured and thought out plan ahead of time of what to do with the money. Let me tell you, I've seen this time and time again where a doctor earns a surplus and then they decide real time what they're going to do with that money. Let me just tell you that never works out very well. You never make the best decisions when you're sitting holding the cash in your hand. You make the best decisions long before that of what you're going to do with the cash when you get it in the future. And the last attribute of a very well designed and executed cash flow system is that your long-term investment goals are automated as much as possible. This is what I like to call automated exercise or automated brushing and flossing. Imagine if you could create a system that would just automatically brush and floss while you're sleeping. That would be pretty amazing. Well, we want to create an automated investing plan, which is like an automated exercise or brushing and flossing, like I've said. Why is this so important, and why have I emphasized this? It's your contributions to your long-term investment plans, planting seeds and letting them grow, that is going to make the biggest difference for you in the long run. That's what's going to make you financially independent and give you the ability to walk away from dentistry or your profession eventually and not run out of cash. But the thing about that is it's so long-term that it's very difficult to get disciplined around it, because we're talking about like sometime way down in the future. It's kind of like flossing. If you don't floss, you'll eventually lose your teeth, but it might take you a decade or more before you actually really see the effects, the long-term effects of not flossing. Now, some of my dental clients might say, no, you'll see effects before that. And I agree, but you get what I'm saying. There are certain things that are so long-term that you want to automate them as much as possible, so you're not thinking about it and having to decide about that on a day-to-day basis. So this is a visual of what the cash flow system in your practice will look like. Remember my analogy of your practice is like the well, right? So think of this big basin right here, or well of water, or well of cash, represents your business checking account. All of the money is flowing into the business checking account through the collections process. And then from there, we've got all of these spigots where the cash needs to go to get to so that everything works. Notice that I have this spillway over here on the side called the surplus. And the water level, where we don't want to dip much below this, we call that the working capital base. I'm going to talk a little bit more about this in a minute. But in short, you've got money coming into your practice all the time through the collections process. Then you've got cash going out through these pipes. And as much as possible, these things are going to be automated, and we're going to take the decision process out of them. Then we have a system to identify periodically this spillway is going to open, and any surplus or any cash that's above this minimum level, what we call the working capital base, will flow out as surplus. And then we've got a plan of what to do with that money. So here's the visual of what the cash surplus plan looks like. Now let's get into the details. The first thing I want to talk about is the working capital base. This is a very important concept in your cash flow system. We also call this the cruising altitude or the water level, back in my well analogy. The working capital is money in your business checking account used to pay the bills of the practice, to keep the practice going, right? We want to set a minimum amount that we will keep in your practice. Now, the cash level will dip below that working capital base, but we're not going to pull anything out as surplus if the amount is below the working capital base. Again, think of this as the cruising altitude of a plane. You don't want to fly so high, but you want to fly high enough to where you can deal with the normal turbulence of a flight and not worry about hitting mountains or trees below. Same thing, we want to create a working capital base high enough to where you can deal with the normal fluctuations of cash during a month without stressing about running out of money. So talking about how high to set this, again, we want to set it high enough to where you're not worried, but we don't want to set it too high to where you're not putting your money to work. So what is the ideal working capital base? I want you to think of this question. If you were going to start your practice on the first day of any given month, how much cash would you want in your bank account to start the month? That's your working capital base. Now, some of you might say, I want $50,000 in my account to start the month. Okay, know that at the very beginning of the month, you're going to have your rent payment go out. Know that you're going to have a credit card bill come out. You've got to think of these things. What's going to happen in the beginning of the month that is going to require cash flow? Maybe your employees are paid on the 5th of the month, right? So you start the month, it's May 1st, but then you've got a credit card payment coming out, you've got rent coming out, and you've got your first payroll on the 5th of the month. You've got to keep those things in mind when you're setting your working capital base. Again, what is the dollar amount that you want to start the month with? So here's how the working capital or the cash flow system works over time with regard to working capital and the surplus. So I've drawn this out for you here. I'm going to assume that the working capital base or our cruising altitude is $80,000. Okay, that's the amount that we want to keep in our practice on a regular basis. So here's where we start, right? We start the month, we'll say this is December, and then here's month one. Here's January, February, March, April, May, June. What we're going to do is we're going to get into the month, and you can see cash takes off, a lot of collections coming in, and then there's a dip in cash, probably payroll run or a credit card bill coming out, something like that. Okay, so cash dips, and then it spikes back up, and here we are. Now we get to the month of January. So what we're going to do, the spillway that we're going to open, where we're going to look at our surplus and we're going to take out any surplus, this is going to happen on the last day of every month or the beginning of the first day of every month. Okay, same thing. The end of the last day or the beginning of the first day, that's the moment in time where we're going to take a snapshot and we're going to look, how much cash do you have in your business at this moment in time? And in this particular case, there's a surplus. This doctor ended the month higher than the $80,000 working capital base. And so you can see right here, this amount is the surplus. There you go. And we're going to pull that money out of the practice and we're going to use it towards our goals. Make sense? Then, because we've done that, we're going to start the next month at 80,000. And you can see this month is not so great. Cash dips and it doesn't come back, and we end the month below our working capital base. Now, at this point in time, you're not going to take money from your personal accounts and put it back into the business. You're just not going to take a surplus. Then we're going to start that month this is now February 1st. We're going to start the month of February with the lower than working capital base amount. And you can see we're going to hum along, and then things really pick up in the practice, boom. And we jump up here, we've got a big surplus, okay? And now we get to March 1st, February 28th, or March 1st, and we're going to identify how much of the surplus is, and we're going to pull this out. Then look at this, in March, again, we're starting with 80 because we pulled out the surplus, and then we're going to go up. Look how the practice shoots off, and we get to the end of March, beginning of April, and now we've got a huge surplus, okay? That's really cool. Those are fun months to have. And so there it is. And then you can see the next couple of months, this doctor ends below the surplus. This is very normal. We're going to project what we think the average surplus will be. This is called, we do this through the break-even analysis, but what this looks like, where you've got a surplus month here and no surplus, then 2 months in a row of a surplus, followed by 2 months of no surplus, that is very normal for a dental practice. So this is how the surplus plan works. Let me pause for a minute and just ask you a quiz question. I should have this up on a slide, the question itself, but here's the question. If we finish the month of January, let's just say with a $10,000 surplus, we finished January with $90,000 in the account, okay? When do we have to pull the $10,000 out? That's the question, okay? Give you a minute to think about that, or you can pause the video. Okay, now here's the answer. The answer is you pull out the $10,000 anytime during the subsequent month. But once you click over into the following month, this surplus is now obsolete. And if you didn't take the $10,000 out, then we're not going to have you take the $10,000 out in the subsequent month, because the surplus plan starts over every month, okay? So that's question number one. When do you have to take the $10,000 out? Notice that you don't have to do it on the first day of the month. Remember, the goal was to start the month with $80,000. So if I actually started the month with 90, as long as I pull $10,000 out anytime during the subsequent month, then it's the mathematical equivalent of having started the month at $80,000. Okay, next question. Same scenario. I've got a $10,000 surplus at the end of January. Now, in February, I go to actually pull out the $10,000 and I look at my bank account and I don't have the $10,000 surplus in there anymore. Let's say now the checking account balance has dropped to $75,000. Do I still pull out the $10,000, or do I not pull it out because I have $75,000 in there? Or on the flip side, what if it's like this month right here, and I go to pull out and I've got another $10,000 of surplus from the month of March, and now I'm from the month of February, now I'm in the month of March, and I go to pull out the $10,000 surplus, but I look at my account and there's $100,000 in there. Do I pull out $20,000 because there's $100,000, or do I go back to the prior month end and pull out the 10? The answer to that question is you always go back to the prior month end and pull out the surplus that was on the end of the last day of the prior month. That's your surplus for this whole current month that you're in. Okay? So those are really important. You have the whole next month to pull the surplus out or to use the surplus towards your goals, and you always go back to the prior month end. So using a monthly cycle, this is very, very important. The first thing is we need a consistent measurement, a consistent point in time to take measurements of what the surplus is. We could do it every 3 months. We could do it every 6 months. We've chosen to do it every month. Why? Because it's more frequent. And also, we reconcile the monthly bank account. We reconcile the bank account every month, so we always have that starting point. The other thing is, during the course of a month, you generally have a full cycle of bills. In 1 month, you pay rent once, you make your loan payments once, you pay payroll once or twice, hopefully not more than that. You pay off your credit card once, etc. So you're getting a whole cycle of bills in 1 month. And so we use a monthly cycle to identify the surplus. So let's talk a little bit more about how the cash flow system works. We've been talking about this. We're going to continue on this topic. Here's the thing. At the end of every month, we reconcile your bank account. Or let me rephrase that. At the beginning of the subsequent month, we go back to the prior month end and reconcile the bank account. So today, right now, it's April 18th, 2024, and we are currently in the process of reconciling all of our clients' accounts as of March 31st, the end of the prior month. Then, once we get that reconciled bank account balance, we compare that to the working capital base. Now, why is a reconciled account balance really important? A reconciled bank account balance takes into consideration deposits in transit and checks in transit. So, for example, if you have $100,000 in your business checking account, but you wrote a $20,000 check, that $20,000 is going to sit in your bank account until whoever you wrote that check to cashes the check. And so a reconciled account will know that you wrote the check, and it will remove the $20,000. So it's a truer balance of the actual balance of your account. So then we compare the reconciled ending balance to the working capital base. And if the bank account balance is higher, you have a surplus. And then you use your surplus towards your goals. Again, remember this point. The goal is to start the next month with the working capital base amount. That's the goal. Start the next month. And so to do that, as long as you pull out the surplus anytime during that month, it's the mathematical equivalent of having started the month with the working capital base. So now I want to talk to you at a very granular level. If you're a Practice Financial Group client, which if you're listening to this video, you probably are, we're going to prepare your financial statements. We're going to reconcile the account every month, and we're going to send you an email saying, congratulations, doctor, the financial statements are done. They're in your portal if you want to go look at them. But in that email, we're going to take a snip of something out of a report that's in the financial statements. And we call this the cash management report. And so here's what the cash management report looks like. It shows for every month for the prior 12 months what the ending cash balance was in the account. And then we compare that to the working capital base, and here's the surplus. So we tell you exactly this is your surplus. So in February 2023, this doctor ended the month with $107,211. The working capital base was $80,000, so there was a $27,211 surplus for February. Then in March, you can see things didn't go very well. And the ending cash was $34,491. And so the surplus was negative $45,000. So this is important. At this point in time, we might make some changes to your financial plan. We might reduce the amount of taxes we're paying, or we might stop investing your money, or there's a whole bunch of things we can do to manipulate the cash levers. But you're not going to go and take money out of your personal account and put it back in the business just to get the working capital base up. Almost never will you do that. Cash in the business comes from the operations of the practice the vast majority of the time. Okay, I want to talk about another point. The surplus is related to profit, but the surplus is not profit. Okay? It's related to your profits, but it's not profit. For example, in January 2024, this doctor didn't have $4,977 of profit. The profit number is different. This is a cash flow number. This is the ending cash balance. So in the prior month, let me show you an example. From May 2023 to June 2023, the working capital base went from negative 40,000 to positive 54,000. So this is a $94,000 swing. Okay. And that's the best way to identify your profit, is the change in the cash from month to month, not just looking at the cash balance. Okay. So anyways, long story short, you're going to get this from us in an email, and it's going to tell you you're going to get this in February, because this is the January 31st, 2024 financial statements. You're going to receive this during the month of February, and it's going to say, congratulations, doctor. Your ending cash account is $84,977. Your working capital base that you set with your financial planner is $80,000. Therefore, your surplus is $4,977. It's that easy. All you do is look at this email. We will tell you exactly what your surplus is. Then the question is what to do with the surplus cash. Here's what you don't want to do. What you don't want to do is decide month to month what to do based on what you feel like doing that particular month or that particular day when you get this email. That's what you don't want to do. What you do want to do is plan ahead using your highest brain and your best thinking about what's most important to you. So for this particular client, the first thing they're going to do is take a draw and pay tithing from the prior month. That's really important to this particular doctor. So that's surplus priority number one. The second thing is take a draw, save in your Capital One taxes account until the balance reaches $120,000. The third thing to do is to take a draw, pay off the SoFi student loan. Now, these surplus priorities will be customized to each of you based on your goals, your values, and where you are in your financial life cycle. The important thing is to, once you make these surplus priorities, is to stick with them. It's like creating a game plan and sticking with the game plan. We don't love to see audibles very often. So I hope that's helpful, and I hope this makes sense. Talking more about how the cash flow system works. A good cash flow system should require minimal effort from the doctor. Okay? Minimal effort from the doctor. That's important. So here are some tips to accomplish this. The first thing you're going to do is automate all payments that can be automated. Like rent, you should not be writing monthly rent checks. If you're writing monthly rent checks, go make a change right now. If you don't know how to make a change and how to automate your rent payments, contact your financial planner at Practice Financial Group and we will help you. Paying off your credit card in full each month. Every single one of you should have your business and personal credit cards automatically set to pay the prior month balance in full each month. You should never be remembering, oh, I've got to go make my credit card payment. Any other recurring bills, cell phone, insurance, internet, anything that can be automated should be automated. And here's the priority of paying bills. First, we want to automate everything on the credit card that can be automated. You're going to be paying for it anyways, you might as well get the points. The second thing you want to do is automate with the checking account, anything that can be automated. Finally, you'll pay with a credit card, things that can't be automated. And if you can't pay with a credit card, you'll pay with a check. So paying with a check is a very rare occurrence. Okay? So here's the cash flow management system in review again. Collections come into the practice. We've got this working capital base. All of these things down here, debt, overhead, taxes, your net pay, and investments, we're going to try to automate these things as much as possible. Your debt, overhead, taxes, those things we're going to try to fix the payments when we can. And your net pay and your investments, we're going to fix those payments as well based on your financial plan. And then you've got the surplus and the surplus priorities. Make sense? Okay, moving on. I want to talk about some individual parts of the cash flow system that I think are very important. The first one is debt. Our goal for every single one of our clients is for them to become debt-free as soon as reasonably possible. Reasonably possible. It's a very important distinction between as soon as possible. All debt payments should be set on autopay. There is no debt that you have that you should be writing a check for on a monthly basis. Every debt set on autopay. And this is important. Set them on autopay to make the minimum debt payment. Here's the catch. When we want you to pay off debts faster, one debt will be selected at a time, and that debt will be paid off as soon as possible. Here's what we do not want you doing: making an extra $500 payment to every single one of the debts that you have. That is not a good idea. Minimum payments on debt, set on autopay. We're going to select one debt at a time to focus on and to attack until it is gone. Make sense? Next part of the financial plan or cash flow system is taxes. I feel really sorry for doctors who don't have a proactive tax plan. That's one thing at Practice Financial Group that we give to you. It's our gift to our clients is a proactive tax plan that they can trust. Your PFG advisory team will proactively manage your tax projection for you. You do not have to think about your tax projection. You just have to follow our lead. The taxes you owe will be determined primarily based on the profitability of your practice. We don't know what the profitability of your practice is going to be. I'm recording this, like I said, on April 18th, 2024. I have no idea what the profitability of my business is going to be for the tax year 2024, and neither do you. But we are going to be monitoring this on a monthly basis, and we're going to be projecting out based on what we're seeing, and we're going to be making tweaks all along the way for you. Our promise to our clients regarding taxes include the following. One, you won't pay more than you legally have to. Okay? Number two, you won't get hit with a big surprise tax bill. We hate surprise tax bills. We hate delivering surprise news. You hate receiving surprise tax bills. This is something that we work very hard that you're not hit with a surprise bill. And the third promise we have for you is you won't have a tax bill that you don't have the money to pay. We're going to see the tax bill coming. We're going to tell you in advance. And why is this so important? This is absolutely critical to your cash flow system, because if you don't know what your taxes are going to be, you can't identify the surplus and you can't confidently use the surplus towards your goals. So taxes is a really important part, not just of your whole financial plan, but it's a critical component of the cash flow system. The next part of the cash flow system that I want to talk about is personal spending. Now, of course, we want you to be able to enjoy the fruits of your labors. The other thing is all of the money that you earn in your lifetime, every dollar will be either spent or given away. Okay? Everything will be spent or given away. If you die with $10 million, hallelujah, that money at that point in time will be given away, right? So the big question is, how much should I spend now and how much should I spend later? That's not our decision to make. What we're going to try to do is to try to put in context for you how you're doing towards your long-term financial plans, and we're going to help give you the tools that for you and your spouse to make an appropriate and accurate decision on how much to spend now and later. A couple of things that I wanted to tell you about spending now versus later. Now in America, very few of us need coaxing on spending more money, right? 90% of the time or more, we need to talk people into spending less money. Just know that there's not a one-to-one ratio between spending now versus spending in the future. Because you can invest your money and you can earn an investment return higher than inflation, it's not a decision of, do I want to take a vacation to Hawaii now, or do I want to take a vacation to Hawaii later? It's more like, do I want to take a vacation to Hawaii now, or do I want to take 4 or 5 vacations to Hawaii later with the same amount of money? Okay, so that's something to keep in mind. Now, you're going to have to balance that with, will there be a later? I don't know. These are tricky decisions. The other thing we want you to know is that the more you spend now, the harder you'll have to work and the longer you'll have to work. This is like climbing a mountain with a backpack. The more you spend, the heavier the backpack is. And so some people don't want the burden, the financial pressure to have to produce so much. The easiest way to lighten your load is to cut your spending. So let's talk a little bit more about personal spending. You're going to determine how much you spend. We're not going to make this decision for you. We will tell you on occasion if you're getting out of control or if you're crazy, if we think you are, but at the end of the day, it's your decision to make. Your PFG team will provide the context for this spending. Here's what we do feel strongly about. Once you decide how much you want to spend, we will make sure you get that money through the payroll system, okay? So if you tell us, I want to spend $15,000 per month, and you're paid semi-monthly or twice a month, we will put into your personal checking account $7,500 each payroll. Now, like a normal person with a job, we strongly urge you to limit your personal spending to what you get paid through your paycheck. Okay, which is what you've decided that you want to spend. In other words, we caution you against using your practice like an ATM. People who spend through everything they get through their paycheck and then pull money out of their business account every time they have a whim on something they want to buy, those people, it's like living with a pantry full of junk food and then just going to that pantry anytime you get a hankering for some sweets. And doing that and trying to be physically fit. Now I want to talk about investing. This is not a lecture on investing, of course, but investing and the cash used to invest is a really critical component of the cash flow system. The first thing I want to tell you is investing in your practice or your ability to generate cash flow is the first and most important investment you'll ever make. We always advise doctors to first invest in themselves and in their ability to generate income. But you don't want to invest in yourself forever. As quickly as possible, you want to get up to your maximum or tolerable income level. And then we want you to quickly start investing outside of your practice. Investing outside of your practice is what will make you financially free. So we're going to use the cash flow system to do the following. First, we're going to automate investment contributions as much as we possibly can. And the second thing is we're going to use the cash flow system to identify the surplus, which that surplus money can then be used towards your investments. Every single one of our wealthiest clients has this in common. They get to a point very quickly where they've got everything else in their life paid off or under control, and their surplus is going towards investments. And then month after month, with incredible consistency and diligence, these people invest their surplus into their long-term investment accounts. It could be argued that automating investments is the most powerful and most important part of the cash flow system. This is what will help you become wealthy in the long term. So the cash flow system in review. Creating and managing a good cash flow system will accelerate you towards your financial goals. This is critical We need a cash flow system that will reliably identify the surplus, first of all, and second of all, give you a plan for what to do with the surplus. What you need to do is to simply wait for our monthly accounting email, look at that accounting email and see what the surplus is. And then if there's a surplus, use it and follow the plan exactly. No audibles is the best plan. I hope this has been helpful. I hope you can feel the importance of the cash flow system. I hope you can understand it. If you have any questions at all, we really want to hear from you. Until then, I hope everything goes well for you.